Thank you very much for joining us. Such a pleasure to have with us today Omar Taheri of Swiss Asia Holdings based in Singapore. Welcome.
Thanks, Oliver.
And with us is also Roshan Padamadan of the Luminaries Global Fund, also based in Singapore. Welcome to the program.
Thank you.
And the topic for today is really what it's like to be an emerging manager in Asia, and we're going to talk about some challenges of being an emerging manager. We're going to talk about some trends that are important for emerging managers to consider, as well as look to you for some advice and practical examples of how to overcome some of these challenges as you're looking to build not only a great investment track record as a manager, but also a sustainable business. So perhaps a good first question, Omar, if you could share with us, just based on your experience of talking to hundreds of managers in Asia and seeing their struggles, what sort of struck you as important, and also how have you then developed a service that can help emerging managers?
Mm-hmm. Thanks, Oliver. Essentially, what we do is we provide emerging managers an incubation service, because we find in Asia that there is a lot of smaller managers launching out here. Small, what I mean out here is managers sub 20 million. For them to set up their own fund structure, it might not make sense. So what we provide to them is the infrastructure to operate in a highly regulated jurisdiction like Singapore or Hong Kong, where they can freely operate. Why they would make sense of someone like us is that we provide them a lot of, added value in terms of economies of scale, synergies with our investor network, and also actually providing them a working space to operate under. I find that in Asia, and Roshan can add to this later, that there isn't the scale of investors that is there in the States. Out here, okay, there is this animal called family office, but do family offices really allocate to small emerging managers? I think it's on a case-by-case basis. They don't really have a set procedure when they look at emerging managers. They perhaps get introduced by a friend to this emerging manager and then choose to allocate. Fund of funds out here in Asia, a lot of them have disappeared after 2007 and 2008. So, who do these smaller managers look to? They can look towards their friends, their families, and their own network that they have available. But I guess what we provide is we have a platform that they also get access to our own investors as well as theirs. So, the synergies are clearly there. And perhaps you can also share your, concerns when you had launched your fund.
Sure. So when I launched the fund, the considerations we had was that my primary skill is investing, so I wanted to bring my investment skill in the fund. But of course, you need to put a legal structure, the compliance structure around it, and you also need somebody to take care of the trades. Now, in a perfect world, the trades will all settle very smoothly, everything is fine. But in the real world, you always have perhaps a missing dividend or some corporate action. So you need a mid-office. Now, when I looked at the cost of a mid-office, I could have one guy, but then if that one guy he needs some leave because there are regulations around holidays, he might fall sick. So I need two guys. Two guys for a very small fund with very low trading volume, it doesn't make sense. So the costs quickly add up to a disproportionate level. So it makes sense to look for some way to share costs. So there are no hedge fund hotels or easy setup things you can plug into in this part of the world. A hedge fund hotel it's very common in London or in New York, where a lot of small hedge funds are in a kind of an incubator setup. It's very much more well known, the concept. So there are seeders who are used to incubating a lot of hedge funds, just like a venture capitalist will invest in a lot of companies. So the incubator is taking a view that, okay, one of these funds will become big, I want to support 10 of these funds and so on. In Asia, you don't see that kind of incubation. But what we do see is with a platform like Swiss Asia, which we have come on board with, we like the fact that it takes care of the mid-office part. The economies of scale works for us. Also, more importantly, if I hired someone, I also have to worry about their experience curve, there's always attrition risk. What if they leave? Would my middle office just come to a stop? So for continuity reasons and for reasons of experience, those are other considerations for me too. So I'm plugging into an experienced mid office. So I don't have to worry about the mid office being too junior. Did I hire the right person? Because then hiring people, running the team, etc., that all doesn't add to investment performance. So I wanted less of those kind of possible headaches. So it was just simpler to go with a structure which worked for me. So we are doing all public instruments. It's quite straightforward, but still it's always good to depend on an experienced team because they'll know what to do for corporate action, trade breaks, etc. So that's how we came to the decision.
And also, I mean, emerging managers, let's say if a guy leaves a prop desk from a bank, essentially he has never had the experience to run a business. He knows how to take care of the investment decisions, but to run a business is completely different. They need to have considerations in place. How do I choose my service provider, the fund administrator? There's a range of fund administrators out there, different prime brokers. How do I choose the right one for my strategy? So we assist our emerging managers with getting the right match between the service providers. And given that we have a very scalable business, we have now over 18 funds on our platform, we get a good deal with the different service providers out there. So what we want to do is see these emerging managers scale on our platform and help them reach a level where they can run their business on their own. So we'd love to see some of these managers reach 200-300 million, spin out of our platform and run their own show. That's what we're about.
And perhaps just to step back a bit and think about an emerging manager who is going through some of that thought process. And of course, there is always that option to stay within your own four walls and just keep producing an investment track record, perhaps just cover really minimally the various other non-investment bases, sort of bootstrap the investment operation, if we can call it that. And then the expectation, I guess, is that there will be a good track record in 3-5 years, and then that person will step out of the four walls, and then there will be all these capital providers lining up to invest based on a great performance. Would you say that that's a sort of too optimistic way, sort of an illusory way of thinking about how this process works versus really trying to put in place such a scalable platform on day one and not waiting for that great performance which may never come?
I mean, for us it made sense from day one. It was cost effective from day one. So we want to build a 3-year track record. That's a primary objective. So we are quite okay with having low AUM, etc. I mean, for my fund, we actually don't charge a management fee. So we work on a different model of how we want to sustain ourselves. But for us, the main thing was we wanted effective operations and risk management. It was just more cost if we do it with the platform. We don't necessarily have to spin out, because if the platform keeps doing its job, we are quite okay to be with the platform as we get bigger. If at some point our demands of some infrastructure or systems are very different from what the platform likes to do or would or could do, then there is a different conversation many years later. But that's like a call option. If you can spin off if you want to, you don't have to. The platform doesn't have to say goodbye to us. We can actually be on it as even if we get really big, there is no restriction from their side, I'm sure.
Exactly. I mean, the longer he stays, the happier we are. But I mean, if he leaves, that's also a good story for us to tell, that we managed to get this emerging manager scalable. And I don't think, I mean, being on a platform as well for institutional investors is a deterrent. I mean, they look at it on a case-by-case basis again. I mean, if we are offering robust operations to these emerging managers that is very institutional, why shouldn't they allocate with us? Because what we are offering a, let's say, $1 billion fund's infrastructure for a $5 million fund. So for an institutional investor, it makes sense.
And let's talk about this perhaps biggest struggle for all emerging fund manager, which is to raise capital. So help us understand just, Omar, from your perspective, how do you see that process? You mentioned earlier some of the differences between Asia and perhaps the US in terms of who are the investors and who can emerging managers tap into. Perhaps just give us a bit more detail around this issue, which is certainly the most pressing for most managers.
Okay, I mean, the challenge is in raising assets in Asia, I would say there is a misconception in managers that essentially they are not very open about providing their portfolio to other parties. So I guess transparency is key. When an investor asks you, why have you been down, let's say, 20% in a month? You have to be able to give them a good reason why you've been down 20% in that specific month, rather than just saying, oh, don't worry, next question, please. And we've had that happen in the past. I mean, I think what you need to do is build trust with some of these investors. And I think when we've spoken to some institutional clients, that is very important to them. Constant communication between the manager and themselves, even a monthly call just to explain why they're up or why they're down, is very important to these allocators. Who are the investors out here? I would say there is a lot of independent asset managers out here in Asia, especially in Singapore, guys who've come from Switzerland or from Europe and set up a business out here who want some Asian exposure for their clients. So I would say that would be the low-hanging fruit. Okay, I mean, there is family offices here as well, but I think the majority out in Singapore and in Hong Kong are still allocated into their traditional businesses, which is mainly real estate. Some of them, of course, they do go into, financial products, but they do hire an experienced private banker to be, as a fund manager in-house for the family. Or the other alternative for them is to let one of the family members manage that liquid portion of their wealth, like a son. And we've seen that happen. And I don't think, that is the low-hanging fruit. I still think the low-hanging fruit for everyone should be the independent asset managers and the smaller fund of funds if you're a manager who's sub 50 million. I know emerging managers, they knock on the doors of larger asset allocation groups, but again, there is constraints in how much they want to put down with you if you're a $1 million or $2 million manager. So that is what we've seen. I think transparency is key. I would want to see, what your views would be at that.
I have seen when you look at Asian investors, a lot of them, the primary source of wealth is the family business, let's say, for a family office. The business is still running and it is still in the growing phase. So they will probably see maybe 20-30% return on equity on the primary business. So it is a harder pitch to say that, okay, here I can give you 15% low risk and so on. They might say, why can't I take 25% in my primary business? It might actually be riskier to do only one business, but at least they know that business inside out. The family is running it. So there is the opportunity cost is different. High net worth individuals, they might go on to buy a second home, a third home, and a fourth home. So they start building a real estate portfolio. In general, in a growing economy, real estate captures the beta of the market. So it is not a bad play given the state of the markets around most of Asia. So at one level, that's where the market is. So the sophistication is not so high to the extent that many people eagerly look for global hedge funds in this part of the world. So it's a different selling point. Half my investors are newbies, for example, as in they've never invested in a hedge fund before. They come in for the first time. So that just gives you so in a way, I feel I'm expanding the market. And that was one of the calls I took when I started, that, okay, I believe there is a demand out there. I can educate a few people. I won't be able to educate the whole market, but I'll be able to educate a few people to come into this instrument. Hedge fund is a very broad term. It can actually be a very low risk instrument. The word hedge fund used to imply low risk, but now it has come to denote something else with the way media portrays it. People think hedge funds are always all highly levered and they take very big risks and they crumple countries to the ground or something like that. So there are very different connotations of hedge fund. It's a wide spectrum. Of course, we now know that the only definition is it's a private pool of capital, and you and the manager agree to do something. That's all there is. So it can be something low risk or high risk. So this is a very broad definition. So when you say you're a hedge fund, it is a very involved discussion to say what exactly are you doing, what will you do and what will you not do. And if people have never heard of something like this or never heard a hedge fund pitch, then it's a very different kind of an educational process. So the opportunity cost for family offices, the preference for real estate by both individuals and family offices, that is one. Institutions who come in might be very risk averse in terms of they might like to go with the bigger institutions first. As this market becomes more sophisticated, they might feel willing to take a portfolio approach to seed smaller managers and so on. So I've spoken to some seeder here, for example. This is a US seeder. They have a person here. He has seeded only one fund in the last 2 years. The rest of the time he's allocating to already existing large managers. So he's not doing much of the seeding part, though of course his counterparts in the US would be doing a lot of seeding. So they are not yet taking the portfolio approach here. By portfolio approach, I mean similar to the earlier example of a venture capital seeding many different startups. He knows that some may not really make it big. But that approach to seeding hedge funds has not yet come here. That particular type of capital, a seeder capital or allocation capital, is not yet there in Asia in a big way. Well, it's non-existent actually.
I mean, Roshan brings up a good point. I mean, it's still the larger managers who are still seeing the allocations being made towards them. I mean, look at prime brokers. I mean, the prime brokers, they have their own cap intra type of model as well. So what we found is that the prime brokers, who are they introducing their own investor base to? It's the managers that are generating them the most revenue. So, I mean, I think emerging managers need to push their prime brokers a little bit as well and say, hey, look at our performance. Perhaps you should introduce us to some allocators at your end as well. So I think that's key as well, to push your service providers to assist you.
And before we move on to some other concerns that emerging managers have beyond capital raising, I'd just be curious to actually ask you, Roshan, about your experience of kind of decision to do what you do, and then even before the choice of whether to become part of a platform or stay more on your own with a lot of these functions. I'm curious, give us a sense of your background a little bit and what made you confident that you can pursue this path. And then perhaps, Omar, from your perspective, I'd be curious to hear what do you look for? So why did Roshan make it to your platform? What was it of interest, and what perhaps do you see in some other emerging managers who come to you, but you have some concerns of your own to actually, maybe they're not at the stage yet where they should be actually pursuing this?
Okay. So I always felt I had some investment skill, but I didn't think I was very rare. I thought, for me, it's more common sense. I did my first trade when I was 13. I bought some shares which were half of what I thought they should be, and they did double in a couple of years. I paid my dad some interest on the IOU I took from him. But I didn't think I was a genius or something. I thought it was just common sense. I knew that stock very well. It was a company my dad was working for at that time. But over the years, I mean, after business school, then I worked in a few countries doing different things, many things across financial services. I even started my career outside financial services. I was a consultant for a couple of years, IT consultant, information technology consulting. Now, over time, then the last 3 years, I was in asset management. And then I was doing more complicated or sophisticated stuff. I was doing option overlay on stocks and so on and so forth. And I was finding it quite easy. I mean, if you do your work, your fundamental work, you can get money without too much risk. By even just taking blue chip risk, you could get 8 to 10% a year. Now, why this was significant was, actually, I grew up in India. I'm Indian. So 10% in India doesn't sound like much because the fixed deposit will give you 10%, the certificate of deposit, US. But of course, India is a high inflation country. So you have to always adjust currency. So 10% in Indian rupees is probably like getting 3% in USD, for example. Now, over the last couple of years, what I realized that a lot of people were struggling to invest their money. And I could sense that around my circle, my friend circle, and some of the senior people I knew in banking, these are people, because not everybody in banking is, for example, an investment professional. They would have done well over their career, but because earlier easy decisions of just putting in a fixed deposit, your certificate of deposit pays you an interest slightly higher than inflation. So in real terms, even if you're not making much, you might be making 1% more than inflation. Everybody was happy. So in an earlier era, before QE, for rich people, there was an easy way out. If you're not a big risk taker, just put it in the bank. You'll get slightly more than inflation. You're okay. For people without any money, that's a different issue. They just have to work their way and earn capital. That's a different topic. But now, if you save money and put it in a bank, you're guaranteed to lose in real terms, because you'll be the person paying for the recovery, paying for QE. So I decided I won't be one of them. And I decided I'll help my friends and my circle by saying, you know what, you don't have to accept the 0.1% the bank gives you. You can do something more. I actually started talking to some people and saying, if you write puts on Coca-Cola, you can get 6% a year at the strike puts, fully margin, not doing it for leverage. So it's a fully cash secured put. So I mean, you have to pick something. You have to say you have to take either Coca-Cola or you have to take 3M. Just pick some stock. You have to take some risk, because even when you put money in a bank, you're taking the risk of the bank, right? I mean, there is deposit insurance, but after that, there's the bank risk. Now, when I looked at this, I was seeing that there's a big disconnect. Even fund managers I saw were very conservative in their personal portfolios and so on. So people treat the money they run very differently from the money they run for their own sake. And actually, usually with the trading restrictions and so on, there is a tendency not to do anything on the personal account. I used to have a very active personal trading account when going through all the clearances and so on. So I used to invest across different countries. And I came to the view that not many people are doing what I'm doing, which is reading actively around the world, looking at the cross-border deals. There are bargains if you look for it. I realized not many people are actively looking the way I was looking. People are usually very siloed. It's also a function of the way the industry has developed. The money management industry over the last 50, 70 years has developed with silos. So if you're a US small cap manager, you do only small cap. Actually, if your best company becomes too big, you actually have to sell it because it's now mid cap or large cap. Then you go back to search for something else. My way of approaching investment, it resonates more with how Warren Buffett looks at it. Actually, his investment style has been different over the last 50 years plus. He has kept changing his style as his money grew, and he ran his partnership very differently from Berkshire Hathaway. So I was trying to learn from the best. So I believe I have a self-taught PhD in Buffett, for example. So trying to learn from him, there's a lot to emulate. The important thing is to get the philosophy. So I felt that, okay, if you take care of the downside, make sensible bets, I would tell people how with taking a little bit of risk, you can beat global inflation. You have to, of course, be very sure what your risk level is. And that was a way to go forward. So there was a period early last year when a couple of people said, maybe I'll give you $1 million. Will you help me invest? I said, no, I work with the asset manager. I can't take it. But someday I want to run a fund and maybe I'll come to you. Then at some point I thought, maybe I should do it because I think I see a market demand. So at some point I took the call. I said, okay, I'll do this. I feel there is enough of a demand. So even though I'm a very small fund, I have 7 different investors. And I believe they will allocate more over time and there will be word of mouth and so on. And for me to de-risk myself, I raised equity capital separately for myself to fund myself for 3 years. So I know the conversations can be very difficult about whether the manager has luck or skill, and people might wait 3 years for it. So I decided to build it like a proper business. So I raised capital for myself separately, and then which is why even though my AUM is small, it doesn't matter because I've covered my costs already in a separate way. So that's how I approached this. I saw a need. I kind of approached this as an entrepreneur and kind of put a structure around it. And for me, the decision to be with a platform made economic sense and practical sense because I don't want to be hiring a couple of mid-office guys and then supervising them, because if something is wrong, they'll come to me anyway and I'll have to solve it. So it helped me to not think about those things as well.
And just before we get your view on this, Omar, I'd be curious, just you mentioned, so you raised some equity for yourself, so you, am I understanding it correctly that you gave up some part of your management
I gave
company,
up.
or?
Yeah, I gave up a stake in my management company. I gave up 1/3 of my company for about $1 million in capital and capital commitments.
And that allowed you to be patient in terms of you can wait, you have expenses, you sort of secure your personal financial life.
That's
that
right.
You can sort of be patient with your decisions,
right.
and up to a point certainly, but
That's
for
true.
enough time to give you that
And-
comfort.
That's true. And if I want, I can always raise more capital through a rights issue if I need more capital. But this will cover me for at least 3 years, I believe. The important thing is that my skill is in finding ideas where people are not competing so much. So I think a lot of the market is not looking at the 2-3 year horizon. Everybody's trying to make money in 0 to 6 months. So there's very little competition in the 2-3 year horizon. So I'm looking at that time horizon. I want my investors also to look at that time horizon. I funded my business also for at least 3 years. And actually to show that, I'm actually taking my performance fees at the end of 3 years. It's an open-ended fund. If they leave earlier, the fees are crystallized earlier. But otherwise, I take it only at 3-year anniversaries, kind of encouraging a long-term vision from the investors as well.
And Omar, just to get your view on this, I'd be curious, how do you then look at somebody like Roshan as opposed to someone else who perhaps shares the passion, the heroes, Warren Buffett, and how do you differentiate perhaps and make a judgment on who to take up on your platform? Who do you really think has what it takes to not just be a good investor, but also to think like Roshan about building a sustainable business?
Essentially, our business model is made to be agnostic in terms of who we bring on board. It's like taking a call option for us. If we take on board 10 managers, we expect, let's say, 2 to fail, 6 to remain the same as they were, let's say 3 years later, and then 2 to really succeed. And that's where we make our revenue from. So, of course, it's nice to have an experienced manager on our platform who can deliver. But I guess when I look at managers and I understand the differentiator between being a successful fund manager and an unsuccessful manager, I think the ones who are successful, they have a clear business plan. They've got a pipeline of investors in the next, let's say, 2 years who are willing to allocate into the fund. So, I think the guys who are successful have a clear vision in place. The guys who've approached us who we can see won't be so successful as guys who don't have their own capital, are not sure where their business is going. And we're very tentative to bring them onto our platform if they don't have any capital allocated to them already. I guess people like Roshan and our other fund managers, why they really like our platform is because I guess words like, let's say, FATCA, AIFMD, it scares some of these managers because they're not sure, what's going to happen. And for them to start looking into it, taking care of, let's say, legal issues, cross-border marketing, it gets very timely for them. Essentially, if we can take away some of that pain, for us to take care of all the regulatory work at our end, and them just to focus on what they're good at, the investment, the research side of things, that's what's important. So we help them in terms of getting successful. So I think it's very important to find the right partners when you're running your fund business.
So here, actually, I did some background research of the concept also, apart from the specifics of Swiss Asia. So I spoke to a couple of managers who are running their own shop in Singapore. They are fairly sizable. One of them is running about 80 million, another is running about $250 million. They run it with 3-person shops. So manager, another analyst, and a risk officer. One is manager, risk manager, admin. They run it with 3 people shops. So But I asked them, how much time do you spend on the non-investment related stuff? And the number they gave me was, I end up spending half the time. Because if you are going through the own license route, maybe this is something specific to Singapore. It will be true, of course, in any country. You have to follow the local rules. There'll be local filings for the fund manager, the firm. So you need to audit the firm. You need to show the compliance reports for the firm. You need an internal audit apart from the external audit. Now, these things add up in terms of demands on time. So what happens is when you're the main person and also the investment manager, because you're the main person, a lot of these questions will come up to you. This is the audit report. Could you vet it? Because it's your firm, you probably still have to look at it. You can't be the CEO and not look at it. So one approach is, of course, you can hire a very good, top-notch CEO or CEO to take care of everything. Then you can be independent of that. But in a small shop, it tends to be, if you are the main person who left everything and you are starting it, you might be the main person. And if half the work comes to you, it is something which is possibly taking away from investment performance. Maybe you can still manage, but it is a risk. So in one setup, the key person was actually envious of his number 2 person, because he said, oh, my analyst can read all the time, I can't. So that was one light bulb moment for me, because I was like, I admire him a lot, he's a great guy. I was like, I don't want to end up in that situation. I would rather be risk averse to the other side, and I just want to read. I read all the time. I read a couple of books a week and read the news and process ideas. I don't want to be distracted with other things because they are interesting in a different sense. I'm also an entrepreneur because I set up this thing. I came out and I started this thing. But I know my main skill is investing, so I don't want to be distracted by other things because they are not value adding for my end investor. That was one epiphany for me as well.
Absolutely. And Omar, you mentioned some of the terms that perhaps scare some emerging managers in terms of the regulatory burdens, and we'll get to that. Just also curious to kind of pin it down, if we can, on perhaps a minimum requirement, or just give us a sense. When we say emerging managers, clearly there are some managers in that definition that, let's say, have, they're only their own personal assets, which may not amount to much. And then you mentioned, Omar, I believe that you need to see evidence that the emerging manager has already some capital allocated to them before they come to you. So just give us a sense in terms of numbers, if possible. What are we talking about here in terms of emerging managers? What's the minimum?
Sure. Again, Roshan's case is very different, given that he sold off some equity in his business to get some working capital. At our end, what we see to make sense of a fund, 5 to 10 million is the guys that we see a lot. Again, a lot of these guys have a very high total expense ratio because, running a fund is not cheap. To run a, let's say, $10 million fund, the annual fees amount to around 70 to 80,000. It's not cheap. Your investors start to get hit. So I guess the majority is 5 million at the moment. What we've seen is how do you really know, how many commitments you'll be getting day one? You always hear this term chicken and egg question. What we advise some of our managers to do is perhaps to send out a commitment letter to their day one investors, and also perhaps set up an escrow account on the side. This might be very interesting because I don't see a lot of managers do that. The day one they start running, perhaps before that they've told us, look, Omar, I'm going to be launching with 20 million. Day one, maybe they only have 2 million launched. So it's good to be prepared the moment you launch, that you can put your money from your escrow account to the actual fund, so you actually have your 20 that you promised. And I think that's the way managers should view things.
We have taken a more homegrown approach. So like Omar said, I have equity to fund myself separately to take care of the front office fees. So we don't put any front office fees or travel research fees to the fund. They're all taken outside. So I thought I'll start with 2 million on day one, going up to 4 million in 90 days. That's what I believed in December. We started in de facto. So now we are 2 months into the fund. Today is like the 60th day. We started with 1 and just under 1 actually. We will get another 300 100,000 today. Even the last 100,000 is, it's not sure. It may come in today or it might come in 2 days later, which means it will be 1 month later. So we are aiming to get to 3 million in another month. So the 4 has become 3. The money which is missing is not lost forever. It's kind of pushed out. Some people suddenly get cold feet. They'll say, "You're so young. Maybe I should wait 6 months," and so on. I tell them I've been doing it for 20 years, but sometimes looking young can be a negative. So some of it might get pushed out. It's not because if I counted it in my earlier count, it's not people who have. These are people who have said they're very interested and I would like to support you or something like that. So sometimes people are interested, then they say, I don't want to put too much of my portfolio in this. Maybe I'll wait for some more wealth to come in before I come in, something like that. Some people have said they'll come in when their bonus comes in March. So I'm hoping for a lot of my friends to come in March, which is 1 month later, because that's bonus season for much of the banking world. Actually, in my fund, couple of my investors are a couple of my ex-managers. So that's always a good word of confidence for me. I'm very happy to be associated with their long-term plans. So I actually have a preference for individuals because I can see directly who I'm helping. Because for me, I'm also helping them. It's not just about them putting money in the fund, because I'm helping them grow their wealth. So this is how I looked at the capital pipeline. I wasn't too worried about hitting a particular number, because for me the 3-year track record is the main product for me. There are some practical considerations. If you're less than 5 million, for example, it's very hard to get more sophisticated level of service from the prime broker. So they want you to be bigger because it has to be cost efficient for them as well. I always debate with them. I say, on a marginal cost basis, your marginal cost is probably 0. Why don't you give it to me? But on a full cost basis, if they allocate all their costs, then as a small fund, as a full cost basis, we are probably loss making. But on a marginal cost basis, we are profitable. So it depends on. So they're taking also a little bit of a call option kind of a thing to add us on. It doesn't really cost them in marginal terms. So we keep having this debate. So it also helped us. So as part of a platform, because they have existing relationship with service providers, including prime brokers, we were probably able to get support, even though we are smaller than a typical hedge fund. So that is another positive which we couldn't have got on our own. Of course, the prime broker wants us to be bigger, and we were also aiming to do that. But some things can't be rushed. Investors make up their decision their own time. What the fund manager can do is you keep your head down and you keep doing your work. That's what we can do.
And perhaps let's just talk a bit more about these, let's say, seeding deals, if I can call them, or giving up some equity in your management company. How often does that happen here in Asia? Is that so to get from, let's say, 0 to 3-5 million? Is that sort of what people do, or how else can one sort of scale up from essentially nothing or some personal wealth, but not having any other people involved?
I mean, I would say sophisticated seeders, there is some out here, but the amount of deals, as Roshan mentioned before, that they've actually completed is maybe 1 or 2 a year. So again, I mean, the guys that get these type of deals is the experienced guys who've been, let's say, at Morgan Stanley, Goldman. These are the guys who are getting a cut from these seeding deals. Emerging managers, I don't see them getting, I guess, a ticket from these sophisticated seeders. It's just because they are not familiar with who are these guys. They have no name behind them. I mean, that's what we've seen. And I mean, what the typical deal size that these guys are looking at, 5 seeders I know here in Singapore, they want 20% equity stake for 20 million, which I think is a nice number to start with out here in Asia. 20 million for 20%, I would take it any day. I guess you would also know at your end, having marketed your fund to a few seeders out there.
Well, I didn't market it to seeders. So what I did was I raised equity from friends, people who have known me for between 13 years to maybe someone as recent as I met about 2 years back. So I sold them a stake in my company for cash. So there was a valuation. So we had, it's not a big secret. So we had $2 million US pre-money valuation. Then I sold them 1/3 for $1 million US. It's capital and capital commitment. Some money will come in over time. But I believe it will come in. If it doesn't come in, it's like an automatic buyback. So I'm not too worried. We have no management fee in the fund. So I needed the capital, and this I felt was the best way to align it. So I felt I'm selling the fund to my friends, so I didn't want to take a management fee as a concept, because actually as the fund gets bigger, the management fee becomes a revenue source. It becomes a big profit center. So as some professors have pointed out, hedge fund managers actually dial down risk as they get bigger, because your management fee becomes a bigger part of your P&L. You don't need to aim for the performance. Actually, it becomes risky from a business perspective to aim for outperformance. So you actually go into more liquid names. You take less of active risk. You dial it down. You may not become an index fund, but you dial it down. Now, for me, the fun is in active investing. That is what drives me. I've kept it as 0.25. It's also what Buffett did in his partnerships. It's very easy to explain. And I figured out that the 25% call option, it's quite good. It covers my expenses. Only thing, it's lumpy. There are a lot of industries which are lumpy. Semiconductor industries. A lot of industries are cyclical. And the only way to solve a cycle is you either need equity or you need a bank or a line of credit. Of course, banks won't give a line of credit to a startup. So we solved it with equity. Because even when you do a seeding deal, like when somebody gives 20 million, you can work it out as a cash flow, right? So if 20 million at 1% is 200,000, right? So that's what they're giving you for the next 3 years, if that's what they committed. So if you're given up that much for 20%, so it's 600,000 into 5. So you sold it at a $3 million valuation. So I would say my valuation is around that, but I like this. It's cleaner. I've told my shareholders that don't expect anything for at least 5 years. It's a 15 to 20 year play for this one. I intend to keep investing for 50 years. This particular structure, I don't know how long it will be, but I guess, like Warren Buffett says, first you start managing money for others. That's a good way to start. It's also because at this point, I don't have any significant personal wealth, so that's why it's easier for me to raise money. All my investors saw a business plan and so on. They put in. So I told them, you're taking a venture capital risk. The company is 10 times riskier than the fund. The fund does blue chips. This one is not a blue chip. It's a very risky venture. So I drew up a shareholder agreement and so on, so they knew what they were getting into. And I keep giving them periodic updates. So it's again like what Buffett said, being a businessman has made me a better investor, and being an investor has made me a better businessman. So in a very small way, I'm both. I'm a very small businessman. I'm also an investor.
Let's perhaps move on then to talk about some of these other concerns that emerging managers have. So you're now set up, you either have the situation that you just described with this Roshan, but whatever the case may be, let's talk a bit about some of these other pressures and perhaps how the burden has changed over the last 5 years for emerging managers. Just give us a sense for what it's like to be in the front line with just a lot of these other things that Roshan consciously doesn't want to deal with.
Yeah, I guess nowadays, with changing regulation, with the IFMD come through, managers here have to rely on reverse solicitation when marketing to European investors. And marketing a Cayman vehicle nowadays to European investors just does not fly. You need a local presence out there. Luxembourg or an Ireland vehicle works. I think European investors now want the safety to have also the local service providers, have all the service providers within Europe rather than have it in another jurisdiction. So I guess startup fund managers need to be wary that marketing is becoming very, very segregated. Even in Asia, I mean, they've got these passport initiatives between, let's say, Singapore and the other Asian nations. I mean, Singapore, Indonesia, Thailand, then also China and Hong Kong. They've got a arrangement there that allows them to cross-distribute funds to one another. Managers need to be aware of that, and they need to understand how it works. So, I mean, I think a platform is very important to them, that they can actually, I guess, siphon the information and relay to these fund managers how they can actually market to specific jurisdictions. What we do for startup fund managers who want to market to Europe, and given that a European vehicle is perhaps twice the cost, even sometimes 3 times the cost of a Cayman vehicle, we also provide them with a renting a compartment in our European umbrella structure. So that allows them to actually access European investors a lot easier, and then to get it set up takes around 2 to 3 months for us. So, I mean, joining a platform gives you that scope to market on a global scale, because I guess we have investors from all over the globe, so we need to be compliant in all the different jurisdictions. So I guess guys like Roshan, if they do eventually want to actively market to Europe, they can piggyback off us and essentially open up a cell in our Luxembourg vehicle.
Yeah, we won't actively market. We'll wait for them to come to us.
Yeah, that's it.
And because essentially nowadays information is much more well communicated through databases and so on. So people will find us, and that is one aspect. The other aspect is I spoke earlier about managing the time of the managers. I mean, we have a scarce resource. We have a very, very small team. There's me and there's a product specialist. The rest of the team is the risk team and the other shared resources of the platform. Now, if I look at things like what do I want to do? Do I want to fill a form PF and a form ADV? Actually, I know how to fill them. I've helped fill them for a $5 billion fund, because in my previous role with the global bank, we had a very large long fund, and we had a modestly sized long short fund. It was around $170 to $200 million. So we used to fill this for the US investors, because we did have US investors. And I know all the fields in the form. I know how to fill it. But in my current role, if I fill it, it's not a good use of my time. Currently, we have made sure, actually, we are below, I've actually read all the SEC rules, so we are below the threshold at which we have report, so we are fine. When we cross the number, maybe in a couple of years' time, or maybe this year, if things go well, then we know how to fill it. But the platform will help me take care of that. So I need to be aware of it anyway, because it's still my fund. So as a manager, I need to be aware of it, but I don't have to sit down and fill it myself. So that I'm hoping for those economies of scale, economies of scope as well, because the same compliance officer can look at 10 funds. If you have 10 different managers at a broad economic level, if I have, actually one of my former colleagues who had left the bank I was with, she reached out to me when I was setting up. She was like, is there a possible compliance role that you have set up? I said, you'll probably have like 2 man-hours of work a month. Now, it's not very efficient. I mean, if you're running a lot of money, you could employ 2 mid-office people, like compliance office people, but actually from their satisfaction perspective as well, they won't be learning much. There'll be very little work. The economies of scope just naturally makes sense. Later on, at some point, if the manager's desires for control systems, etc., diverge very differently from the system the platform provides, then there could be a conversation. But at this point, it's just the simplest and easiest thing to do. Actually, I have a mentor who is a former hedge fund manager. He's American. He used to run funds from 1992 to 2001. He looked at me, he looked at the thing and he said, Roshan, we didn't have this back in the day. It's great you have this option. It's great. So there's very limited downside. So you should just do it. So because I asked his advice as well, because should we be independent and strive for independence, or should we join a platform? Because he said, what do you want to do? You want to invest. So you should just get on with it, because people always know it's you, it's your fund. so it doesn't really matter. It doesn't. So it's just a good partnership. Then you can proceed with your things, because if your investment skill is there and it's working, it'll always be there. It doesn't matter in which form you are. There were some other practical considerations. For example, we spent a couple of months looking at all the aspects. We even looked at where do we want to domicile the fund. So we spent some time on that. Then even going for the own manager license in Singapore, the time period to get the license approved, it's not a definite day 90 or something. It's an unknown period of time. So it could take 6 to 8 months. So I've seen one manager took her about 7-8 months to get the license and so on. So that is an unknown period of time. And they also expect you to staff up a bit more. They usually want at least 3 people, 2 investment professionals, and 1 other person to take care of risk. So I am the main investment person. I think I'm capable of fully handling the portfolio, sizing, construction, everything. I don't need 1 more. I mean, if somebody is willing to work for free for a stake of equity, then that's a different conversation. But we don't have the cash flow to support a lot of investment analysts, and I believe I don't need them for a long time. Actually, till 1.5 billion, which is my calculated. So just to get a license, I might have to hire 1 more person, and so on. So that was not a very that was an early challenge to the business, because when you set up, you don't want to, because hiring the next person is a very big decision for any startup, not just a hedge fund startup, for any startup. So that will be a decision which should have been forced very quickly on me if I decide to go the independent route. Unknown period of time. I'll have to hire people who would not have too much work on an ongoing basis. The costs keep adding up very quickly. And the risk reward is the costs are surely going to go up. My AUM is always, it's not sure to go up. And as we have seen, there have been a couple of surprises on the AUM where I started with half of my starting AUM, which I thought on day 1. I'm still running below my expected run rate. It's not a problem for me per se. I mean, for the investors, we have capped expense ratio, etc. We just made sure that the early investors don't have any onerous burden. We have capped it. So anything over a particular number, we will just take it ourselves. We picked up all the setup costs. We are a very small fund. We are conscious of that. So we picked up all the lawyer-related setup costs and so on. So they're not being amortized. We just picked it up. So that's how we approached it.
And just briefly, if that's possible, to go through that decision to domicile, you mentioned it,
okay,
and just some considerations there for somebody who is not that familiar with the subject. I guess what are some of the most important considerations to consider when it comes to just also the regulatory framework that you've been describing, Omar? So give us a sense of that decision to domicile.
Sure. Okay. I mean, I guess domiciliation depends on where your investors are. I mean, let's say all of your investors are in Europe, I would choose a Luxembourg structure. It just makes sense. And let's say all your investors are in Asia, you choose Cayman. I mean, that's just a general trend that people choose. Also, I guess you need to know, I mean, your future investor base. Let's say you have a lot more institutional investors that are very European. They like a very regulated jurisdiction like Luxembourg. Cayman nowadays is, I guess people call it like a cowboy's playground, where there is a lot of flexibilities there. But in Luxembourg, with the CSSF, they've got their set guidelines, they've got their restrictions. It's very strict. So if you want to keep a very broad fund, we would usually recommend our clients to choose Cayman. Also in terms of cost, I mean, if you're a smaller fund and you've got, let's say, sub 20 million, I wouldn't recommend this setting up in a more regulated jurisdiction like Luxembourg, because I guess the costs, they start to add up. Once you reach that level, you can always re-domicile your Cayman fund to Luxembourg. It'll cost you, let's say, 20,000-30,000 US, but in the end, once you're scalable, it's just a small basis points fee. So it's very important to know, I guess, how much you're starting up with, where your investors are, and what your ambitions are with the fund. Because you can also, I mean, rent out a segregated portfolio under someone's umbrella structure. you can do that. But then, I mean, if your business ambition is to eventually spin out of that structure and set up your own, it's a lot tougher to do so. So, I mean, a standalone vehicle is the easiest way if you want to spin out from a platform. In the end, when you compare a segregated portfolio and a standalone type of structure, the only place you're really saving is in the startup costs and the timing it gets set up. Let's say you need a fund running in a month, segregated portfolio is definitely what we would recommend for our clients.
For us, we were targeting global investors. Eventually, it will be global. But we also recognize that the first investors we had some from the US. There were US persons living in Singapore, for one, and somebody from the US as well. And then other people like Singaporeans, Indians, and so on. So we wanted something which would work. There was an initial reaction to Cayman from I mentioned earlier that many of my investors are actually new to hedge funds. So the initial reaction was, Cayman, isn't that like some kind of a slightly funny place? Are you sure Cayman is a good place to start a fund? So I took that feedback very seriously. Ultimately, it's the customer's money. So I spent a lot of time researching Luxembourg. We even researched putting the fund in Delaware, as in the main fund in Delaware. We looked at putting the main fund in Singapore. Different considerations. I don't know how much time you have, but let me give you a quick summary. So Delaware is usually used as an onshore feeder. You take money from US in a feeder. A feeder is essentially a fund which takes it and puts it into something else. The something else is the same strategy. Essentially, if you take money from two sets of people, say US investors and non-US, the traditional structure is the lawyer will tell you do a master feeder. Essentially, you'll take one for all the US guys, one for all the other people. Just to make things complex, some US institutional investors will come in the other category for tax reasons. And then the fund manager wants to trade only one portfolio, preferably. So both become feeders and they come into a master fund. Actually, if you're a tax aware, it doesn't make sense to combine them, but that's how most of the industry works. I mean, for me, if I were running money only for US investors, I will run it in a different way with tax efficiency. Right now, I'm very small, so we're just doing one fund. Now, this master feeder now the thing is you're paying for three setups. There are three companies being created. Each company is a separate entity, so you need to do audit of all three. Of course, the main audit is of the master, but you still need to have audit statements for the other two. So the running costs go up because there are three things to do. The setup costs are higher. You can try to minimize some costs by removing one feeder, but then there are other considerations. Laws are always not perfectly clear. Some things are based on, what we think we can argue with a tax person or something. So there's something called a mini master where you remove one leg and you just have one feeder, one master, and US people can come in directly into the master. The other feeder is a corporate entity. So it's a good lesson in corporate finance as you go through this thing, because a partnership is different from a corporate. So the tax treatments are different. For most people in the world, it doesn't matter. But for US investors, tax treatment for a partnership might be more beneficial typically than going into a corporate structure. But for some people, like a pension fund who doesn't want to lose their tax benefits, they want to go through a corporate. So the lawyer will call it a corporate blocker because it blocks them from being a partner. The corporate veil comes in. So these are some of the considerations. So there's always a lesson in corporate finance and company law which you need to go through. And these structures are not the same in all countries. Singapore, actually, we wanted to be in Singapore because of all the double tax avoidance treaties. But we realized that it's very hard to domicile a hedge fund in Singapore because Singapore doesn't have a fund structure per se. Luxembourg has a whole menu of different fund structures. But Singapore has only a corporate structure. So the short answer is something like, when you want to take in money, it's fine, you issue more shares. But when you want to redeem, you cancel the shares, but that becomes a reduction in capital. That becomes like a company law event. So the directors have to sign off every time there is a redemption, saying that the company is still solvent. It's a different level of obligation than a fund just redeeming some shares. Why is it so complicated? Because it's not a fund structure, it's a corporate structure. So you can force fit a fund into a corporate structure, but the running costs go up because of all the extra paperwork. So the lawyers won't say very clearly, oh no, you can't do it. They'll say it can be done, but it's difficult. So then we ask them, okay, so how many people have done this? So they're like, hardly anybody. Okay, that gave us a clue. And the ones which did it were really big funds, $50 million plus. They might have done it for other reasons, or they can afford to do it because they're quite big. Luxembourg, we looked at it. The timeline was very long and uncertain because it's not clear when they will do it. The expenses add up to a much higher amount, and it is not clear what it is for. It is almost like it's almost like a protectionism in a sense, because they're saying use our custodian. It's the same custodian entity. We can use it in, say, Dublin. It's the same company globally. So the quality of service, the level of process, everything is the same. Jurisdiction is different. You're just paying higher for the Lux jurisdiction. So at this point, we don't have any European investors. We felt if we have European investors, as and when they come in, we can always create a separate Lux feeder or a Lux side by side. So we thought we will solve that later. We chose, usually people will say that US investors, individuals, can't come into a US corporate. We researched that further. So actually, we did our own work. We researched that further, and we felt that we found out, actually, this was advised by the 10th lawyer we spoke to. The first 9 didn't mention this. This is the lawyer we went with finally. So he mentioned that a US corporate can support something called qualified electing fund, can choose to be a qualified electing fund, and they can support what is called a PFIC tax report. PFIC it stands for Passive Foreign Investment Company. So when a US individual invests in any private company outside of the US, it could be a tech startup in Japan or a hedge fund in Cayman, which is a corporate. It's the same from tax perspective. It is just an investment in a company, because a hedge fund is ultimately just a company. So you are just a private company with variable capital. Capital can come in and go. So when they put into this particular PFIC, we will support them with a QEF with a PFIC tax report. They should choose qualified electing fund, and the tax treatment is, in our view, just as it's almost the same as if you invest in a US mutual fund. It is not much worse of it. In my view, it's the same. I'm just being cautious because I'm not a qualified tax advisor. But essentially, I told my US investors, check with your tax guy. We think this will work. So then they checked. They said, you know what, it worked. And one of them was, one of my mentor and hedge fund manager. He has run hedge funds before. He said, I don't think it works because people always say PFICs don't work for US individuals. So he was sure his tax guy will say no. But I told him, no, ask him the specific question. And he went and checked and said, you know what, it works. So we kept costs low by doing one corporate structure. We avoided the master feeder. So we have a Cayman corporate. We did our own work. We spoke to lots of lawyers. But there is another observation here. Usually there is no one single lawyer who can give you a view, because the jurisdictions are all split up. All the Cayman lawyers don't do non-Cayman. They do only Cayman stuff. All the international law firms, typically they don't do Cayman. So the guys who do both, there is no one who does both. The Singapore lawyers only do Singapore law. You need to bring in US counsel for US law. So it can get very complicated very quickly, even for somebody who's, even if you're small, if you want to raise money from different jurisdictions, it can get very complex very quickly. So then for our fund document, we had US counsel and Cayman counsel working together to make sure it covers. Theoretically, I should have lawyers looking at all the 180 countries, but you only worry about the countries with the most, where the laws are specifically talking about this. So most of the countries, we would rely on general exemptions from offering rules and so on, because we are not actively marketing anywhere. We are just waiting for people to find us. So that kind of works, because reverse solicitation is fine in every country, because if people come to you, then it's fine. So we are here. So that's how. So we spent several weeks and months on the setup process, thinking through the structure. Actually, if you look at a hedge fund startup flowchart, the first point is actually hire a lawyer and fix your structure. But it's not so easy. So for us, that first point was 3 months later, because we didn't just go with Cayman because everybody said, just go with Cayman. What are you thinking? I was like, no, I need to know why I should go with Cayman. Then once I'd satisfied myself that Cayman works, the structure works, then we went ahead with it. 70% of the world's hedge funds are in Cayman. Cayman is very flexible. So you have all kinds of funds there, including very large, honorable funds, to maybe some people having shell companies there, etc. But that's not our concern. We are doing a proper hedge fund with an auditor, with a custodian. So we have nothing to worry about the Cayman title. So I actually went to my investors and said, any other jurisdiction is very cumbersome or very costly. This is why I'm doing Cayman. Then they accepted it. So it's not like there's nobody who said, oh, I won't give it because it's Cayman. They all said, okay, fine. We see that you've done your work. We're fine.
And thank you for sharing that much detail with us here. I'm curious, just in the interest of time, perhaps certainly we won't cover all the concerns and answer all the questions of the emerging managers out there, but perhaps if each one of you could sort of reflect on what was discussed and perhaps share some final observations, just something that we perhaps haven't touched on, but you feel is also quite important to consider.
I mean, I guess the message that I would want to send to emerging managers who are considering to set up their fund is to first have a vision in place and set up a solid business plan and understand all the different pieces when setting up a fund. I mean, like Roshan mentioned, don't just go ahead with a, let's say, Cayman fund and not understand why you're choosing that jurisdiction. Actually do the research yourself, find out the implications behind setting up out there, and then also know where your future assets are coming from. So make sure you're in a comfortable place before you launch your startup fund, rather than be bleeding and hitting your investors. So make sure that you have everything in place before you actually go ahead and launch. So speak to 1,000 people out there before you actually go live.
Where I feel most comfortable is when the emails go back and forth between the mid office and the prime broker and the fund admin, trying to resolve some trade breaks. And I'm just watching. I don't have to get involved. I just check it once in a while until it's resolved. Dividends, corporate actions, a contract for difference being booked as an equity trade, or I buy one option on the LIFI market and the Eurex option is booked in, so they have to sort it out. I'm just happy the mid office takes care of things because I have got my hands full reading. So that's when I feel most comfortable that okay, things are just moving along. I don't have to get involved because it's actually their responsibility to fix it, so I don't have to look at it. I don't have to worry about it. I felt if it was my own shop, I would worry a lot more about those things. I would rather worry about the market. There's enough to worry about.
Well, with that, Roshan and Omar, I want to thank you so very much for sharing with us your experiences and offering up some very good advice for emerging managers.
Thanks, Oliver. Thank you.